Let's get back to oil. Ukraine says it hit several Russian refining operations as Kiev intensifies its attacks on Russia's energy infrastructure. We're hearing reports of fuel shortages in some markets in Russia. Let's get more from Stewart Glickman, energy equity analyst and deputy research director at CFRA Research. Stewart, thank you very much indeed for joining us.
Thanks for having me, Andrew.
I think one point you want to make is that a lot, or maybe the vast bulk of Russian oil goes out by sea to countries such as India and China. And the Ukrainians have not hit those facilities yet?
That's correct. So the attacks recently that landed were really on local refineries that are supplying refined product domestically and some for export. And I think what's happened as a result in the aftermath of those attacks is Russia has said, okay, we're not going to allow exports of refined products when local markets would otherwise be starved of refined product like gasoline and diesel and whatnot. So it does mean that there's less refined product making its way to the marketplace. This is probably also an impact on Russian coffers because the price they can sell refined products for overseas are higher than what they can fetch domestically because they subsidize local prices.
Right. So could the Ukrainians attack their seaborne ports and facilities to go after the sales to India and China?
So it's a fair question. I don't know if as you know, from a military standpoint, if that's feasible or not, if those are better protected than the refineries were. I do know that, or think that an attack on export locations on the ports would probably capture the attention of the U.S. administration more extensively, because then you're talking about taking, probably, big picture, Russia exports maybe 4.5 million barrels a day. Probably 2/3 of that is seaborne. So if you start messing with their ability to send oil out to the market, then you've got India and China clamoring for other barrels on the market, fighting with everyone else, and that would drive oil prices higher. So I do think it's a risk that perhaps Ukraine is not taking yet because they're concerned about losing support from the West.
Sorry. Yeah, that's right. I mean, if there was a spike in oil, it wouldn't be popular in Washington. We did get this drop. U.S. stockpiles go up and down, I know. Is there anything significant about the drop in inventories we heard about this week?
Yeah, so it's interesting as a sort of a standalone factoid, right? There was a draw that was bigger than expected. But the big picture is that U.S. crude oil commercial inventories are around 415 million barrels. That's about 4% below the 5-year average. So that is, I guess, the bigger picture to think about here. It's not that we're awash in crude oil right now. We're a little bit below where we normally are for this time of year.
Your projection is oil at around $70 next year, I believe. Are you talking about WTI?
That's right. I'm thinking that WTI should average around $69-70 a barrel in 2026. It looks like it's pacing itself to average somewhere in the $65 a barrel range for 2025. Now, the EIA is calling for a pretty significant pullback in WTI prices next year, in part because demand is a bit sluggish, and in part because there's a lot of OPEC barrels that arguably could make their way back to the market next year. I'm concerned about U.S. oil supplies rolling over, and I don't think, at least based on the estimates that I've seen from the EIA, they're calling for kind of a leveling off of U.S. oil supplies, and I'm concerned that drops a bit more than that.
So that would tend to push up prices, a drop in U.S. production.
It would. If you take some supply that, U.S. supplies have grown pretty considerably from, call it 5 million barrels a day about 20 years ago to 13.5 million barrels a day today. It's a technology success story in the U.S., 2 decades in the making. And if we start to get a pullback, that's something that I don't think the market is really anticipating. And I could argue for about $70 a barrel, which is not fabulous. It's not, you're not, generating tons of free cash flow at those levels, but certainly it's not, running the risk of break-even levels like the EIA is suggesting.
That's interesting. It wouldn't be. I'm just wondering how OPEC Plus would feel about that. It wouldn't be enough to spur massive global investment in new production, I guess. But people think decades ahead.
Yeah. So, energy cycles tend to move in fairly long cycles. And 2004 through 2014 was a great upcycle in energy investment, lots of money being thrown into the oil field at virtually every project you can imagine. And then we went through about 7 years of really, really poor reinvestment in oil fields. We're starting to come out of that. We're still not back to where we were at 2014 peaks. And so, to your point earlier about BP saying that peak oil demand is further off than they originally thought, we're still trying to catch up and provide more supply to keep pace with what should be growing oil demand. And so I think the likely trajectory for oil prices through the rest of this decade is probably a little bit higher because we really haven't spent enough time or focus on driving a lot more production growth to meet what should be an increase in demand.
Stewart, we better leave it there. Thank you very much indeed for joining us.
Thank you.
Stewart Glickman, energy equity analyst and deputy research director at CFRA Research.